Welcome, everyone. Good morning or good afternoon, wherever you're tuning in from. I'm Reid Goossens, the CEO and founder of RSM Property Group, and joined with me today is my business partner, Ben Gray, and the Vice President of Multifamily Acquisitions at Monday Properties, Chris Wiederhold. Gentlemen, how are you this morning or this afternoon, depending on where you're at?
I'm very well. Doing great. Excited to be here. Thank you.
Awesome. Well, for those of you in the CRE Daily audience, many of you are seasoned professionals, and you know how tough it is been to get deals across the line in today's tight capital markets. And yet, over the past 9 months, the partnership with RSN and Monday has been very successful. We've closed on 4 deals totaling 850 units across 3 different MSAs, and we've done this by adapting our to the current market conditions, blending the best of the retail syndication model, which is where we come from, and the advantages of the institutional partnership level, which is where Monday comes from. And that's what we're going to be talking about today, right now. So we'll start the webinar by breaking down how exactly this new quote unquote new model works. And then we'll walk you through a real deal, the Summit 401, which is a live and investable deal currently open to investors. And that should take us about 30 minutes to get through that presentation. And then after that, we'll have an unscripted live Q&A. So with that being said, we are going to turn off our cameras and we're going to jump into the webinar. And for those people who have got a quick note, we're going to have a disclaimer up on your screen right now. You can pause the webinar. This is being recorded. So for just as a heads up, if you have to jump, this will go out as a recording, both on the Monday RSN platform, but also through CRE Daily. But if you do want to download the perspectives, please reach out to us as well, and you can pause to read the full disclaimer right there. Now, at any time throughout this webinar, you want to submit questions to us, you can do so very easily by clicking the Q&A button below. Now, if you would like to secure your spot or reserve a spot in the deal that we're going to talk about coming up here, you can visit us at rsnpropertygroup.com/commit or schedule a one-on-one call with us at rsnpropertygroup.com/call. So with that being said, let's get into the webinar. So we're quickly going to start by addressing who we are. So at RSN, we have been historically a classic syndication private equity shop for the most of our history. We started raising from friends and families money over a decade ago, and we've been focused on value-add investment opportunities across the United States. Now, we have not been one of those syndication shops that has bought deals hand over fist during the current recent market conditions. We've tried to hold strong with our underwriting standards, and that meant doing fewer deals in 2022, 2023, and 24 than we might have liked to. But that said, our portfolio of assets bought in the last 2 or 3 years have been strong and performing extremely well. And in fact, today I should say, we actually refinanced one of our 2022 acquisitions with a very healthy $2 million cash out refi with a favorable 5-year agency debt term. Now, in terms of our portfolio, we are proud to say that we have closed on 30 deals, or we've put 30 deals under contract, and we've fully capitalized on all 30 of them. So, and in the past 2 years, we've started to incorporate what this essence of a hybrid model. We've started to incorporate the institutional capital into our recent acquisitions, which we're going to talk about right now. Now, in terms of our success record at RSM Property Group, I'm going to let Chris talk about Monday here in a minute. We have successfully exited 6 deals, including one as recently as this year. And we're proud to say that we have recouped our investors an average healthy 23% IRR. Now, in terms of the defined strategy of what we focus on, here's a brief snapshot of our company deck. And touching on the investment strategy, it's been very consistent over the last 11 years now. We have been hyper-focused on our niche at value-add multifamily. Originally, we built out a large portfolio in Central Texas, and since 2002, we've actively moved into Phoenix, the Carolinas, Dallas, and Atlanta, always aiming to build up a nice 2 to 5 assets in each given MSA to really start to benefit from those economies of scale. Now, in terms of the deals that we target, we underwrite hundreds of deals a year, and we look to try and find the top 4 to 6 acquisitions to transact on. That last point that I just mentioned is really important to understand. We're not looking to grow exponentially and do 20 deals a year. We're looking to optimize and be sustainable by acquiring 4 to 6 deals a year and structure our business around efficiencies and a real focus on execution. And in the partnership with Monday Properties, we feel like we've found a partner who's well aligned with our strategy and philosophy around multifamily and what we believe today is a historical opportunity in front of us right now to buy great deals at deep discounts. And with that being said, I'm actually going to transition over to Chris, who's going to share a little bit further details on the Monday Properties, I should say. And then Ben will speak about our partnership between the two of our companies and how this hybrid deal structure has really come about here in the last couple of years. So with that being said, Chris, going to hand it over to you.
Absolutely. Thanks, Reed. So, hey, everyone, I'm Chris Wiederhold. I lead multifamily acquisitions for Monday Properties out of our Charleston, South Carolina office. Just for some background on Monday, Monday Properties was founded back in 2002. We have offices in New York, DC, and Charleston, where I sit. Since inception, the firm has completed more than $16 billion in transactions. I would say that historically, Monday's been known more as an office owner. And about 10 years ago, we launched our multifamily platform with several apartment developments, including 2 here in Charleston. And thankfully, those first projects were a success. And since then, we've been expanding our multifamily platform. As of today, we have over 9,000 units acquired, developed, or in the pipeline. And we are actively working and building out our pipeline in the Southeast to continue to grow our footprint. So in terms of our actual strategy, we really like the Southeast. We focus there for our target markets, really because it offers some of the best fundamentals in the country for multifamily investment, namely key indicators like population and job growth, coupled with a high level of rental affordability. And specifically, we're targeting submarkets within these larger metros where rents are lower than the city average. This really creates built-in affordability. It keeps occupancy high, and it can reduce volatility. We also see some really good potential in secondary and tertiary markets like Fayetteville and Greenville. We like that these markets benefit from being near major hubs like Raleigh and Charlotte, while they also offer higher cap rates and yields. And as we're looking at deals, we're really looking for opportunities where we can increase income through targeted unit renovations and amenity upgrades. I would also add that we're really thoroughly reviewing financial statements, especially in this inflationary environment that we've been experiencing, to uncover expense saving measures that can boost cash flow. And in terms of goals over the next few years, we're looking to assemble a portfolio of more than 5,000 units, each property being selected for the characteristics that I mentioned before, but including in-place cash flow. We like limited physical risk and strong value add potential. And then I'll talk about our investment criteria. We're really looking for deals that are between $30 and $150 million with equity requirements of about $10 to $60 million. In terms of a hold period, we're looking at 3 to 5 years, but we stay flexible. So if we see that we can take down an opportunistic deal, create significant equity quickly, we may exit earlier to get investors back their capital sooner. And on the financing side, we really like to use agency loans whenever possible. Fannie and Freddie. So these give us better certainty of execution and the ability to fine tune the loan terms to best match the business plan. We also want to point out that we're really drawn to properties with good rental affordability, and this aligns well with Fannie and Freddie's mission-driven programs. Those often come with attractive interest rate benefits, ultimately boosting returns. This slide provides an overview of kind of how we build our team and think about the infrastructure at Monday. We've been very thoughtful in building out our team to drive both our in-place operations and growth plans. We believe that our team brings diverse experience across acquisitions, asset management, construction, accounting, and IT, and bringing these all together is really important for executing on our business plans. We really make an effort to have the acquisitions and asset management teams collaborate closely from the underwriting process to actually executing the business plan and then to the sale. This ensures seamless alignment in every stage, so all the team members in the deal are marching to the same beat. And at the end of the day, our goal is to increase cash flow to investors by improving NOI. So to that end, we really like deals with minimal deferred. That allows us to focus on CapEx opportunities that have a high ROI, like renovating the units. For example, like if you have to replace the roofs, that typically doesn't provide much of an ROI. That's more of a deferred maintenance item. So during due diligence, we're thoroughly reviewing the property and thinking through the CapEx critically and getting bids and having physical inspections completed. And we're allocating the CapEx thoughtfully to upgrade interiors and exteriors. And then ultimately, this can enhance the renter experience and then allows us to drive higher rental rates. When we actually operate the properties, we're reviewing and competitively bidding service contracts like trash and landscaping. This ensures one, comprehensive scopes, and two, cost efficiency. And then another item that's really important, especially lately, to drive traffic is reviewing our marketing spend. We're looking at this weekly to optimize our traffic sources and ensure that efficient budget allocation is occurring. And I think also most importantly is obviously the exit. We're staying mindful of the next buyer's perspective, intentionally proving out value add opportunities like hard surface countertops such as granite reports and washer dryer installations, with the idea to enhance the asset's appeal for the next owner when we decide to market the property for sale. The key to all of this, and I've mentioned some of this, is really disciplined asset management. That is key to building a best-in-class asset management platform. And I'll just touch on a few items in this slide. Our daily reports keep all team members informed on leasing and collections activities on site. I'm included in those emails. We receive them daily, and that helps us keep a great pulse on the deals to know what's going on site. We have weekly reports that provide insights on trends and performance. They enable the asset managers at Monday to make timely adjustments to optimize results. We also have weekly calls in conjunction with the weekly reports with the on-site teams and regionals. This ensures alignment, and we can address any issues promptly, which is key. We find that finding issues sooner than later obviously helps us mitigate any concerns. Then each month we're doing a detailed review of the financials, and that includes all team members. So the property manager, the supervisor gets involved, the regional. We're looking to identify areas of where we're doing well and also where we're not doing well and how we can improve. So with that, I'll hand it back over to Ben. He's going to discuss our partnership and hybrid deals.
Awesome. Thanks, Chris. And guys, if you want to look at that Monday company deck or the RSN company deck, feel free to reach out to us. We'll certainly be emailing you and you can just ask for that. We'll shoot it straight over. Now let's talk about the Monday RSN partnership. We first connected with Monday Properties in early 2024, and we quickly realized that we shared a lot more than just overlapping target markets and investment strategies. We had a shared philosophy about where the multifamily industry is heading on market timing and on the scale of the opportunity in front of us. Both groups are true believers that the multifamily market has bottomed out and we're standing at the ground floor of the next major market growth cycle. Just as importantly, we both saw the early mover advantage, securing high quality assets now while many groups are sitting on the sidelines, waiting for clearer market signals and looser capital markets. Notably, we're both prepared to roll up our sleeves and target distressed assets. And in the last 9 months, we've wasted no time, closing 4 acquisitions together, totaling just over 124 million in transaction volume. And every one of these deals was capitalized with a mix of retail and institutional capital, a perfect example of the hybrid model we're going to be talking about here. So Villas at Princeton Lake in Atlanta is a great example of speed and flexibility. When the institutional LP had issues at the 11th hour, Monday wasn't about to walk away. The deal was in great shape, cash flowing strongly, thus pref made sense. There was still a $5 million equity gap, and in just 6 weeks, we stood up a retail raise and closed on schedule. Eagle Creek was a very different story, a heavily distressed 1982 vintage asset. Traditional institutional groups had zero interest. We raised the bulk of the equity from a retail investors, and Monday contributed a check to round out the raise and come in as a GP. Alessia Gardens was distressed too, but this time operationally. While there was some institutional interest, the terms weren't accretive to the deal, so we went retail first. And Monday added equity alongside us, and we've kept a placeholder for a full small pref slug currently in negotiation. And finally, Summit 401, the opposite of a distressed deal in every way. It is gorgeous, well run, and cash flowing strongly right out of the gate. It carried a roughly 20 million equity requirement. An institutional LP took half of that, then provided 5 million as an equity bridge, and Monday RSN funded the remainder. The retail raise that we're offering today is taking out that 5 million equity bridge. So 4 deals, 4 very different stories, but one consistent theme: the flexibility and certainty that comes from pairing institutional execution with retail capital access. So with that, what is a hybrid multifamily deal? We've coined it as a capital structure that combines institutional quality execution with both retail investor capital and institutional equity, delivering the scale, rigor, and resources of large cap deals with the accessibility and flexibility of retail syndications. The key characteristics are that you've got institutional quality deals, underwriting and asset management, but a flexible capital stack blending retail and institutional capital as needs dictate. Fundamentally, this hybrid approach allows us to target a wider variety of assets from a dramatically expanded number of capital sources. So let's talk about the benefits and drawbacks of retail and institutional multifamily deals. Starting with institutional benefits. Institutional guys get the best deals typically. Stringent underwriting, expert asset management, all consistent with industry standards. They also benefit from economies of scale and have deep benches of talented folk to draw from. On the flip side, you can't invest with maybe less than 10 million bucks. They can be rigid, and the opportunities outside the norm can often be overlooked. On the retail side, you can get in for as little as $50,000. This gives you the opportunity to diversify your capital over different markets, sponsors, deal types. You're going to get excellent customer service and attention as a $50,000 investor, robust reporting, and the big one not mentioned here is tax benefits that flow down to you personally as an individual. On the flip side, and we'll say it politely, deal quality varies widely, and there can be overly aggressive assumptions in the underwriting. Oftentimes, groups using retail capital are smaller and less sophisticated, bringing knowledge risk and execution risk. And the big one is the fees can be unreasonably high. Now, we think the hybrid multifamily deal approach is a massive win for investors. Everything we do is about providing a better product for our investors, and we really think we've nailed it here. So let's talk about the the benefits of both worlds here. You're getting institutional grade assets and underwriting, low investor minimums, proven institutional quality execution, high transparency, investor care and customer service, institutional fee structures, very easy to diversify your money over multiple assets and deals, and those personal tax benefits that flow down to you as an individual. Now, it's not just investors who benefit. As operators, it makes our lives a hell of a lot easier. It's kind of like we feel like we found a life hack. We can target a higher variety of deals, and we can be more confident in our ability to close. And ultimately, we just have another tool in our belt in the way that we can structure and capitalize deals. And it really, really helps us out to go after the best assets. Now, the benefits for brokers and sellers are fundamentally, it's a higher certainty of close. The deal doesn't fall apart when a large LP can't be found or falls through. And as buyers, we can afford to be more flexible in regards to the timelines and structure. While it's a heavy lift doing a retail raise, the retail marketing model is very predictable. Increase ad spend, increase outreach, and you increase the capital raised. All of this means deals get done at a fair price and on schedule. So that's the hybrid multifamily deal structure. Look, with that context in mind, let's jump over to Summit 401, and Reed going to tell you all about it.
Thanks, Ben. Good summary there. And so now we're going to switch to the active deal that we've got open for investors right now. And this is a gorgeous asset we're picking up from the seller who took great care of it. They've completed their business plan. They purchased it 5 years ago, but now they're moving on as the debt, I should say, has flipped from IO to P&I. As you can see, it's a visually stunning asset, great for marketing, great amenities, pool, gym, kids playground, package lockers, barbecue area, clubhouse. So let's get right into the meat and potatoes of what this asset is. So Summit 401 is a 291 unit core plus multifamily community built in 2012. And it was designed with a lot of modern living in mind. The property features spacious floor plans averaging over 1,000 square feet with 9-foot ceilings. Great landscaping, tranquil, amenity-rich environment for renters, and the community is comprised of 2- and 3-story garden-style buildings. Offers a resort-style pool, 24-hour fitness center, dog park, car wash, as I all mentioned, an expansive green space for those residents to enjoy. Now, the existing ownership has done a great job of maintaining and operating the asset. We're actually inheriting $2.3 million in recent CapEx, which includes 103 units being renovated to a high standards. And that's leaving us 189 units to continue to renovate and push that NOI, which is where our business plan lies. But the most attractive thing about why we're acquiring Summit 401 is the assumable Fannie Mae loan at a very attractive fixed interest rate, I should say, of 3.01% with over 5 years left remaining on the loan. Now, in addition to this highly attractive loan, we're layering in a supplemental loan, resulting in a total in-place leverage of 66.9% LTV with a combined blended interest rate of 4.68. So that means when we compare it to our going-in cap rate, which is a very healthy 6.21% going-in cap rate, this deal delivers immediate and meaningful positive leverage from day one, a very rare advantage in today's market, particularly for such a nice core plus deal. Now, the other thing I would like to mention is that we've already closed on this deal back in late May. So there is no execution risk. If you invest your money today, your money goes straight to work, earning a return immediately. Now let's talk about the basis. We're picking this asset up for $152,000, which is 20% below recent comps. And if you compare it to the market peak of 2022, assets of similar vintage were trading in the low $200,000 region. So, and if we also compare it to replacement costs today, this would cost approximately between $240 to $270K, depending on the finishes, if it was built today. So we're picking it up at a fantastic basis. In terms of the unit mix, we have over 73% of the community comprising of large 2 and 3 bedroom units, ideal for the renter demographic we're looking for, families and those young professionals. It has modern layouts, balconies on every unit, as I mentioned, high 9-foot ceilings. And these are the units that we believe as operators that renters are looking to rent from us. Now, as I mentioned earlier, 103 of the units have already been renovated and have to a high standard. And we're planning to renovate the remaining classic units, which is 189 units, to the same renovation finish. Now, in terms of rent comps for unrenovated units, they're slightly below market, indicating that there is room to push. And in terms of our business plan and our underwriting, we're only planning to match those rental comps that the existing owner has already proven out across the remaining 189 classic units. And I mentioned this earlier, but I do want to reiterate that we've actually already closed on this asset back in May. And the first 2 months of operations, we've already started outperforming the budget in terms of free cash flow because of that positive leverage day one. And we've been outperforming it by $21,000 in the last. This represents a 17% increase over budget. And that is all before we've even lifted a finger on the renovation budget, which is the renovations, I should say, which is planning to kick off sometime in the next 4 to 6 weeks. Now, in terms of some real-time stats, renewal conversions remain extremely healthy, closing at July at 71%, 58% in August. Is on track to do between 60 and 70% conversion rate on 25 expirations. Now, bad debt closed out June at less than 1% of GPR, and we expect this to remain at this level. And the controllable expenses have come in 24% under budget for major savings are in payroll, R&M. Now, in terms of our underwriting, we are assuming a 3% rent growth, 3% expense growth, underwriting consistent with industry standards today. The CapEx is modest, but we're expected to spend about $2.1 million. 1.37 of that 2.1 will be on interior renovations, and the remaining $654,000 will be on exterior renovations. As I mentioned earlier, we're going to be doing light upgrades because the asset is already looking beautiful, including backsplashes, modern appliances, and lighting throughout. Now, I'm going to read debt terms again because I did mention them earlier, but that's the major advantage of this deal. We're assuming the final 5 years of existing 10-year Fannie Mae loan fixed at just 3.01%. As I mentioned earlier, to reach our target leverage of 66% LTV, we've secured a supplemental loan at 17.19%, which brings the total blended fixed interest rate to 4.68, which is roughly 50 to probably 70 basis points below current market rates if we were to go out and try and get that finance today. And importantly, this is obviously fixed debt for the next 5 years. No floating rate, no interest rate surprises. On the flip side, the loan is amortizing principal and interest, but so that is building up equity as we pay down the loan over the remaining hold. And with most agency loans, all the CapEx dollars we are raising upfront as equity. And while that requires more capital at closing, it does allow us to maintain full control over that renovation spend, over the renovation scope, and the speed of execution. And it avoids the risk associated with high leverage floating rate debt. And we view this as true, meaningful de-risking of this investment for our equity partners on this deal. Now, that being said, I'm going to hand it back to Ben, who's going to quickly summarize the market overview, and then we're going to get into live Q&A.
Perfect. Thanks, Reid. Look, North Carolina, great place to do business, great place to invest. It's ranked as a top 3 state for business 5 years straight by CNBC, including number 1 in 2022 and 23. It's attracted over $15 billion in capital investments in 2024 alone. We're looking at robust economic growth with strong manufacturing, logistics, and tech sectors, low cost of living, high quality of life, and business-friendly policies that continue to drive population and job growth. Fayetteville is North Carolina's 6th largest city, with 30% GDP growth over just the last 3 years. Home to Fort Bragg, the largest military installation in the US, contributing over $8 billion annually to the local economy, but it's no longer just a military town. It's now a diverse economy anchored by healthcare, logistics, education, and advanced manufacturing. Property market is booming. Rent growth of 15.4% since 2021 and 18% projected through 2028. Property values have jumped 72% since 2020. And as we said, it's no longer just a military town. More than 2/3 of the industry is non-government. Employers like Amazon, Cape Fear Valley Health, and American Titanium Metal are expanding rapidly, driving job creation and housing demand. And there is a massive amount of investment going on. Amazon just implemented its second 1.3 million square foot fulfillment center near Fort Bragg. And that's going to open, I believe it opened last year, and that added about 500 jobs and was a big provider of significant tax revenue. Project Aero from American Titanium Metal is investing $868 million to build a 500,000 square foot facility, creating over 300 high-paying jobs. And the project is supported by $1.3 billion in county funding and is one of the largest titanium operations in the US. Now with that, let's talk about the capital stack and investment returns for this investment. Now, one of the beauties of a retail offering is that investors have the opportunity to choose between Class A, B, or C, or split their investment across different classes. Class A is a soft pref, a 10% preferred return, no upside profits upon sale. Class A is one of the benefits to Class A is that it's paid out before Class B receives their preferred return, making it a safer, more reliable source of cash flow. It also affords protections in scenarios where the asset underperforms. Class B is your common equity with a 7% pref and a 72-28 back-end split. Class C is for checks of $500,000 or more with an 8% pref and an 80-20 back-end split. And this thing cash flows real healthy out of the gate. So you'll see here we've got a almost 20% project level IRR, 7.6% cash on cash, 18% IRR for Class B, 19% for Class C. And let's take a look at how that cash flow comes together here. With Class A, again, you're getting your 10% every year, and then your initial capital back plus your 10% for a total of 150,000 return on 100K. Class B, I won't read all these numbers on the screen, but the point I'll make out is that you're getting good cash flow from operations starting in year 1 at 5%. And that climbs up to 9.25% in year 5. So very healthy cash flow on this asset. And Class C is the same thing with slightly higher cash flow on the back end when we exceed the 7% Class B pref. The other thing we mentioned is another beauty of investing in a retail capacity is that all of the tax benefits flow down to you. So we typically see 50 to 60% of an investor's initial investment amount returned as passive losses on their K1. So if you invest $100,000, it could be typically around 50 to 60,000 coming back as passive losses. And these can be used to offset other passive income in your portfolio. And with more aggressive tax planning, it may be possible to offset them against your ordinary income. As always, consult with your CPA. Now with that, I'm going to pass it back to Reed to wrap things up and get into the Q&A.
Thanks, Ben. Let's talk about next steps and the timeline. So we're moving very quickly. As we mentioned earlier, we're paying off a $5 million bridge loan, and with this retail capital that we're raising, and that will take place on or before August 20th. The PPM documents are already up on our portal, ready for review and signing, and we will need funds wired by August 20th. Now, we may have additional allocation after this date, but given the speed at which we're pulling in capital in this deal, I wouldn't count on it. So in terms of the big picture, Summit 401 checks the boxes as what we focus on as operators. It's a high quality asset, core plus in a solid physical condition, immediate operational upside and location in a stable growing market. The basis is very compelling, and the structure that we've built means that there's meaningful downside protection to you guys as investors. And from a fundamental standpoint, we underwrote this deal for steady, predictable cash flow with conservative leverage. And given the fact that we're buying this asset at a 6.21% going in cap rate, and we have a fixed interest rate blended at 4.68%, means that we have positive leverage from day one with a hold period that allows us to capitalize on what we believe to be entering a market recovery cycle. Ben spoke about the tax efficiencies built in this structure, and the incentives for us as GPs are fully aligned. We only get paid if this deal is a success. Now, at this stage, it's less about, quote unquote, selling the deal and more about whether, if it fits with the investment strategy that folks on the call with CRE Daily have. If it does, we would always be open to collaborating. So please do reach out to us at rsnpropertygroup.com/call. And if you still have any questions, we'll be diving into those questions right now as we transition to the live Q&A. So with that being said, Ben, I'm going to hand it back over to you and we can start looking at the Q&A.
Perfect. Let's pop our cameras back on so people can see us, and let's take a look. So first up, we've got a good number of questions in here, but we do encourage you to ask questions. If you're shy, you can ask them anonymously. If we don't answer your question fully, ask a follow-up. If you think of another question, throw it in there. This is the interactive part. We're really excited to talk on our feet. And with that, let's take a skim at some of these questions. Yeah, look, here's a good one to start with. Who handles what between RSN and Monday Properties on these deals? Reed, why don't you take a first stab at that, and then we'll let Chris follow up.
Yeah, yeah. So we have controlled decisions 50-50 across all of our deals we do together. Monday leads some of these deals. RSN leads the other ones. On this particular deal, Monday is heading up asset management with us, overseeing that as well, and the construction management. Chris, you want to add anything to that?
Yeah, I think the partnership's great. We can kind of see what you guys are doing and learn from you guys and bounce ideas off of you. And Monday's lead on 2 of the deals we've done, and RSN's lead on the other 2, the 4 in total. So it just happens to be 50-50. But yeah, it's a great kind of partnership and very collegiate. So really helpful for us as we're trying to get creative on the asset management side to drive value.
Awesome. Thank you, guys. And look, we've got the same question from multiple different people, which is how much are Monday and RSN investing into this deal? Why don't you answer that one for us, Chris?
Yeah, so ultimately Monday will have about $2 million in the deal, and that's part of this raise is we do have some equity in the deal that we're going to raise down as we finish out the raise. So that's kind of the intention here is for Monday to keep a significant stake in the deal, which is what we do with all of our deals to show that we have skin in the game. And we drive cash flow for our firm ourselves by driving investor cash flow. So that's very important. It's aligned.
Perfect. Thank you. Trying to group some of these questions together. Again, feel free to throw more questions in, guys.
I can answer this one about with the 3.01 assumable and supplemental. How resilient is the plan if growth underperforms? Well, it's a pretty simple one. Back to that positive leverage day one. If we don't lift a finger and we don't do anything, you're already cash flowing because we're buying it at a 6.21% cap going in cap rate. So there's already that positive leverage built in, whatever the delta is, 160 basis points or more of positive leverage day one. So yeah, if rents don't move or go anywhere, it's still cash flowing. And that's why I mentioned earlier in the piece about the real-time stats about the first 2 months of operations and how healthily it's already cash flowing out the gate. And that's why we think this deal is so awesome, because of that, really, really accretive in place assumable debt. Chris, anything you want to add to that?
Yeah, no, and there's the debt service coverage. You're right. It's cash flowing. It's like a 1.6 year one. So we're in place as well. So there's not. I would say it's covering nicely, and that's amortizing. So not only is it covering NOI to debt service 1.6 times, we're also paying down the loan as part of our debt service.
Yep. One other thing I will mention in our decks, we have assumptions built into our models. We don't have crystal balls, but we do have sensitivity tables. So if anyone interested in looking at how things will look out for LPs, if things change with assumptions, they are in our decks. More than happy to point them to you if you want to download a prospectus.
Absolutely. And guys, look, the corollary question is here right now, a little bit more optimistic. If the market does better, rates, et cetera, does that change when you sell, or is it 5 years firm? So maybe just talk, about the potential for upside in the deal and then how that might impact our selling timeline.
Yeah, well, look, so if interest rates drop, we're locked in with any agency debt. So if interest rates drop, we don't get to benefit necessarily from the cash flow or lower interest rates, but the value of the asset will go up. If interest rates rise, then we have fixed interest rates, so we don't get beat over the back of the head with higher interest rates or high debt service. Chris, anything you want to add to that?
Agreed, Reed. That's the great part about fixed interest rate debt is that you know what your debt service is going to be, and you can do things to drive your cash flow through the income and the expense side. And obviously that's our goal here that we've outlined in this business plan. And we're assuming a 6% exit cap in 5 years. And obviously our plan is to grow the NOI through unit renovations, other income opportunities, better managing expenses. But yeah, if cap rates go down, that's gravy on the exit.
Yep.
Right. Look, we got a question from Nina here. You bought 20% below comps and 64% of replacement cost. What dislocation did you exploit to win at that basis? Chris, why don't you take that one initially?
Yeah, I think to start, the overall market demand is down, right? I don't think that's a surprise to anyone on this call, but you do have less interest at the buyer table than you do back in 21, 22, and it's harder for brokers to make deals transact. That being said, this deal called for offers right before Thanksgiving. It was the holiday season. Maybe you had less eyes on the deal. We also pursued the assumable route, which we didn't even know it was there until we dug in a bit with our questions. So we're not sure that the assumable loan option was well known to the buyer universe. So we definitely jumped on that when we realized that was an option because it's very accretive to the deal.
And Chris, remind me, the exit cap is 6. What's the exit price per door? I think it's like in the low 200s, like it's back at where the peak was of 2022.
Correct.
Yeah. So just to reiterate, guys, like the peak assets were selling, 210, 215, 220 a door. And that's where we're assuming that will be in 5 years' time. So we're, I think that's another really positive from a conservative underwriting perspective. It's not, not trying to drop the interest, drop the going out cap rate down to a 5 or a 4.5 to try and juice returns.
Great. Thank you. And look, here's one I want to take, and then you guys can add color on the back of it. But do you typically place bridge to get the deal done and continue raising post-closing once you have proof of concept in place on the investment? So the short answer is no. But the longer answer is, you look at the RSN track record. We've completed 30 of 30 retail raises, successfully capitalizing deals. And after we did a couple of deals with Monday, they started to get a feel for how it works going through a retail raise, get a little bit of confidence that we have the ability to execute on that. And Summit was sort of coming up, and we've had a lot on our plate. Doing 4 deals in 9 months. There's been a lot of strategic thinking about how we can structure these deals to get them done, how we can, buy a little time to raise more, so on and so forth. So this is kind of the example of the hybrid deal structure, just having these tools in the belt to be able to say, well, look, let's grab that $5 million of bridge, and then we can raise for, a number of weeks after the fact, pay that off. And that's a way for us to get this deal done, hit the closing timelines that everyone wants to, and, basically make it a win-win situation for everyone involved. One minor thing I will note that is important is that we're keeping all investor funds in escrow until we have enough money to take out that bridge. So investor funds are never going to be at risk. We're only going to deploy that when we hit the full amount. Heaven forbid the world ends and we can't raise that money. Investors aren't going to lose money based on this arrangement. Chris, Reed, anything you want to add to that?
No, well said. Just a very probably goes back to highlighting the quote unquote hybrid model of what this whole webinar is about. Thinking strategically, leveraging those institutional relationships, but also leveraging the retail raise model, which does take a little bit longer than someone stroking a big check. And it's why it's called a hybrid model, why we like it, because there's so many different ways and we can execute on more deals at a quicker pace.
Awesome.
Yeah, I think I would just add that I think the hybrid model and the ability to bridge equity at closing and then do a post-close raise is interesting, especially for investors, because you can get a look under the hood and see how we're doing on our business plan. Thankfully, we're doing well at the gate here. And yeah, I mean, it just depends on the deal and the execution. So we have that flexibility where we have various ways to capitalize the deal and really tailor the capital structure and try and optimize it the best we can.
Yeah, absolutely. There's another question that I love to answer. Where's that tax question? What are the paper losses on K1 for the first year now with the new bill? And there was another one that was parallel to this. Yeah, recent policy changes. As most everyone on this call probably knows, bonus depreciation has jumped back up to 100%. So yes, that's absolutely going to benefit the tax benefits that flow down to you guys as investors on this deal. Again, we say like 50 to 60%, and sometimes we've seen it be 30%, sometimes we've seen it be 80%. Villas at Princeton Lake, just as an aside, we structured that one for maximum tax losses, and that was if you invested 100,000, I can't remember if it was like 96 or $100,000 in passive losses that flowed through to you. So as a philosophy, we're always trying to maximize those tax benefits to you guys in year one by doing a cost seg, by doing everything. And yes, bonus depreciation jumping from 40% to 100% is going to be a big benefit and boost that number up. Is it going to boost it up, 50 basis points? No, sorry, 50%, no. But, you might get a little bit of a boost from that. So it's going to be net positive, but I don't think it's going to be, massive, so to speak. But that is that one answered. Look, there's a question here on fees. So how are Monday and RSN's fees? Chris, you're closest to that. Why don't you go ahead and answer that?
Yeah, we take an acquisition fee of 1.5% of the purchase price, and we take an asset management fee, which in this case is about I believe it's 2% of the income. I'm just double checking, but yes, I believe that's correct. So those are our fees, and obviously we get paid on the back end if we pay your money back and you promote. And as Reed mentions, like that's how we're incentivized, right? The deal performs, we get paid, we do well. So very much aligned in that regard.
Totally. And RSN has never been one of those syndication groups to charge the 3.5-4% acquisition fees. We've never charged a disposition fee. We've never been one of those fee machine shops. And obviously stepping into the institutional world, our modest, 2% acquisition fee we'd charge on a syndicated deal has been pushed down a little further, and we have absolutely no problem with that at all. We're here to make our money on the back end when the deal's a big success. Let us look for another question here. Were investors who came in before the acquisition nervous about deflated returns with the high bridge rates? The short answer is no, because that was all factored into the model. So the returns that they were expecting to get, accounted for, the rates on the bridge and whatnot. We might even be able to close out that bridge a little bit sooner and beat our own plans. But no, that hasn't been a concern. Candidly, most retail investors aren't really getting into the minutia of the deal, so to speak. They're really looking at those total returns. They're betting on the operator, they're betting on the business plan, and they're taking a much broader view of the likelihood of success and the comfort that they have with making that investment, as opposed to maybe looking at, is it a 12% rate, a 20% rate? What are the terms on it? That's the kind of stuff that they look to us as operators to be able to make competent decisions about, and execute and make sure that their distributions and total returns are hitting on time. Look, there's a good question here. There's a couple of good questions that, Chris, I'm going to throw to you, which is, how does Fort Bragg impact the stability of the rental market in the area? And what is the property's exposure rate to the military?
Yeah, that's a great question. So obviously Fort Bragg, the property is about 30% military. And then you've got a lot of teachers, medical professionals. So we've got a great demographic mix. But yeah, Fort Bragg is a huge driver, as Ben mentioned, billions of dollars of economic impact, 66,000 troops and associated employees, Department of Defense. So yeah, your military residents will have a shorter notice period if they get deployed. But we still get notice. So you can plan, turn the unit. It's interesting because the troops get a voucher, which I believe is like around $1,300 or $1,400. It might be a little bit less than that, but basically, you get a housing subsidy if you're in the military, and our average rents are about $1,300. So you can come here and have most of your unit paid for. have money left over for food, gym memberships, whatever. So that actually like supports occupancies and delinquencies because that's a subsidy that's coming from some government associated payment source. So that's great. That helps DQ. But yeah, no, we're mindful of that military exposure. We try and keep it around 30% or less, just so we can kind of, there will be fluctuations in deployments from time to time. But this property's been 95% occupied since 2021. That was something we looked at very thoroughly in our DD. So we're definitely very mindful of that. But we'll also offer incentives to our troops to have them stay at the property. They've been great residents.
Awesome. Awesome. And look, I'm going to put you in the driver's seat again here. We've got 2 questions here. So what are the upgrades or amenities that you see adding the most value to this since it's a 2012 build? And a corollary question, you can sort of answer this all together as well, is since the deal is already closed, what have you done so far in terms of stabilization and business plan execution?
Yeah, so I think the seller did a great job on modernizing the units. They already have granite countertops, so those look great. But the classic units have like brown cabinets, a whitish paint. They don't have any hardware on the cabinets. The flooring's like brown. So we're renovating the units, putting in a backsplash. Those light upgrades are going to cost about $6,000, but they really modernize and refresh the unit. And it's just nice you don't have to do any hard surface countertops. Those can cost $3,000. So that's a huge saving there. So I think, obviously renovating those units for $125 pop is a huge value add for the property. The seller also really did a good job on modernizing the amenities, the fitness center, the pool, the clubhouse. Those all look great. So we're really focused on the units. We're planning to maybe put like rubber mulch in the dog park and do like light amenity upgrades. But most of the capital, as you guys could see in the prior slide, is focused on the units. In terms of our business plan, we're finalizing our interior renovation bids. We have everything bid out except for the paint. We're pushing on a few vendors to come down on cost to make sure we're at or below that $6,000 that we budgeted. So planning to start unit renovations in the next few weeks. And in terms of the business plan, we've renegotiated a few contracts. We're making sure our landscaping is being taken care of. We just got a termite bond in place. Yeah, working through the business plan day by day.
Awesome. Great answer there. I'm going to quickly get a softball question out of the way. Will you be sending this presentation via email? Yes, this will come out from Cree Daily and also the RSN mailing list. And again, if you want to see the RSN company deck, the Monday company deck, anything like that, you're going to have our contact information. We're going to be in communication and we're happy to send you anything, answer questions, get on calls. That's what we do again as a retail, institutional, hybrid model shop here. We're available, great customer service. We're going to help you with your due diligence. And, we really want to develop those relationships with you guys to feel comfortable, invest with us in not just this deal, but multiple deals down the line. We got a few.
I can answer the couple too here if you want.
Sure.
You mentioned a recent exit. What's the usual game plan, and how do you decide between a straight sale versus a refinance? And there's one down here. What are your thoughts on investing in the southeast broadly right now with recent demographics and jobs? So the first one is pretty simple. Is like this deal. Unless someone comes to us and I'm talking for Chris and Monday here, but unless someone comes to us and we'll have some sort of defeasance getting out between now and 5 years. But if we get a real nice offer and it eats that defeasance, well, of course we'll sell sooner and maximize the IRR. But yeah, this is probably going to go for the full 5 years. I think it's year 4.5 the yield maintenance burns off, Chris.
Yeah, something like that. 3 to 6 months.
Yeah, like you start looking to soft sell it maybe year 4. But that's the beauty of this deal's positive cash flow day one. So, there's no noose around your neck. And if you come to 5 years and, hey, the market's not great to do a whopper exit, refinance, and it's such low leverage. It's only 66.9% right now. So I think there's an easy hurdle to jump on an already really attractive basis that we're picking it up at. And then the second question was about our thoughts. Yeah, look, the population are continuing to move to the southeast. And Chris, you would love your thoughts as well. And Ben, the big issue has really been around the supply and absorption. We see that completely falling off a cliff, particularly in this market. Across a lot of Sunbelt markets. We just did a state of the market webinar last week about talking about key markets across the Sunbelt and their absorption versus rebound. We're seeing a lot of those key markets that were hit hard with supply really bouncing back really well right now. And in terms of supply in this particular market, there's not a lot coming online in the next 3 to 4 years. So that's only going to boost rents, increase occupancy, and obviously drive returns for investors. Chris, anything, or Ben, anything on those last 2 points?
No, look, I'll jump in and say we've come pretty much to the end of the webinar here. So any final questions, shoot them over. Otherwise, Chris, you wrap that question and any final thoughts, and then we'll close her out.
Yeah, it's a great question on the Southeast, because obviously there's been a lot of growth, migration to the Carolinas, Florida, Georgia, Texas. And with that, there's been an onslaught of supply, especially in like Charlotte or Nashville. Like some markets just have, they receive a ton of supply. And I think, there's opportunities in those markets. Like I mentioned before, like there's more affordable markets, like some markets of Charlotte where maybe new supply isn't justified. So it could be interesting there. And there's enough of a delta between B product and A product where you're more insulated synthetically from new supply. So I think that's interesting. Like our deal in Atlanta that we bought with RSN Villas of Princeton Lakes is in West Atlanta, lower level of rents and just generally less supply. But it'll be interesting to see. Like I think like Raleigh, you're seeing demand outpace supply a bit more meaningfully there than you are at Charlotte. So it sounds like Charlotte is a bit more runway for absorption, but I think definitely we're all keeping an eye on those big Southeast markets that have had a lot of supply to see, how they do over the next year or two, especially as all these construction starts have stopped. So that's just my 2 cents.
Awesome.
Love it.
Softball question here to close it out. How and when are preferred returns paid? Quarterly, directly to the bank account of your choosing via ACH, like clockwork? Look, I'll say my little piece. Just thanks, guys, for joining. We appreciate all the questions. We're really happy to be here speaking with the CRE Daily audience. Do reach out to us. We'd love to connect. Reed, Chris, any parting thoughts?
Thank you all for taking some time out of your day to tune in. It's been really awesome to see the attendees and asking some great questions. Chris, anything else?
Yeah, I'd echo those sentiments. This has been great. Love explaining the business plan and the deal. Happy to answer any questions. The ones we've received have been great. And yeah, grateful for the partnership with RSN. And we're looking forward to getting more and more involved with this deal and get the execution underway.
That's right. Thank you, everyone.
Thanks, guys.
Thanks, everyone.